Warren Buffett, a household name in the investment world, has inspired countless investors worldwide with his remarkable journey. As the chairman of Berkshire Hathaway, Buffett's success is a testament to the power of valuing investing and contains a lot of insight for the followers. Hello and welcome back to our YouTube channel. Today, we're going to talk about Warren Buffett's letter to shareholders, key takeaways, and insights. So without further ado, let's get started. Before we dive into the letter's contents, let's briefly talk about the man himself, Warren Buffett. Even for someone as modest as Buffett, his rise from selling chewing gum as a kid to becoming a billionaire investor is truly remarkable. He presides as chairman and chief executive officer of Berkshire Hathaway, which has outperformed the market for decades. The yearly letter from Warren Buffett, one of the world's 5 wealthiest people, is widely anticipated by the investment community. In addition to providing insightful corporate updates, Buffett freely offers investing advice and insights into how he has achieved legendary success. In light of recent economic instability, this year's letter is a magic elixir that has been long anticipated. For investors, it takes on the qualities of a magical tome full of enchanted methods for weathering the financial storm. Buffett has become their go-to expert, his words acting as a magic wand that wipes away their worries and points to the way of financial security. Like students at Hogwarts, investors classify themselves into one of 4 houses: the brave Gryffindors, the stoic Ravenclaws, the dogged Hufflepuffs, and the crafty Slytherins. The buzz of speculation on online forums is palpable evidence of the growing excitement. Readers are hypnotized by the promise of riches when the letter finally appears, and they devour every word. The most important thing to take away from Warren Buffett's annual letter is his unshakable faith in the American economy despite the current hard economic backdrop of inflation, rising interest rates, and recession fears. He portrays a positive outlook, saying that Berkshire Hathaway is in a special position to benefit from the American tailwind. Geico, Duracell, and Kraft Heinz are just a few of the household names in the conglomerate's profile, which also has substantial holdings in American Express, Coca-Cola, and Chevron. In the wake of last year's market slump, when investors may be worried about the state of their portfolios, Buffett's time-tested investment technique of identifying and acquiring great businesses at favorable prices resonates profoundly. As Buffett has done with Berkshire Holdings, investors would be well to adopt the strategy of keeping investments for the long term if they want to succeed in today's volatile financial markets. Buffett's unwavering optimism stands out at a time when the investment community is grappling with the effects of inflation and economic instability. Moreover, Warren Buffett's latest letter to shareholders may cause you to rethink your investment strategy if you've been relying on news articles and quarterly earnings reports. In 2022, not even Berkshire Hathaway, with all of its financial might, could withstand the capriciousness of the market. The corporation made an impressive $30.8 billion in operating profits without including the value of its stock portfolio, but things weren't so bright when the stock portfolio was included, resulting in a $22.8 billion loss. Using no equivocation, Buffett calls these GAAP earnings 100% misleading and criticizes the media for focusing blindly on quarterly gyrations that misinform investors. It's a harsh caution against putting too much confidence in metrics that fluctuate wildly, like profits and stock prices. Buffett's advice, in its simplest form, is that you shouldn't put too much stock in numbers that are subjective to constant change. He elucidates bold, imaginative accounting, a method through which dishonest business leaders might mislead their investors. Think of the stock market as a raging ocean where numbers crash into the nerves of traders. Buffett says that we need to take a long-term view in order to succeed in this environment of constant change, mastering the capacity to ignore short-term swings and instead concentrate on a security's long-term potential is the key to financial success. The concept of stock investing needs to be reevaluated in light of Warren Buffett's brilliant investment strategies. Although the name implies that choosing stocks is the main objective, Buffett pushes us to redirect our attention to what really is important: the future of companies underlying the stocks we're considering. Successful investing, in Buffett's view, is less about anticipation in short-term stock movements and more about identifying and capitalizing on businesses with long-term favorable economic qualities. After all, rising stock prices are a natural consequence of a successful corporation. Buffett stresses this attitude when he explains that they seek to make substantial investments in companies that have long-term promises and are led by honest, capable people. It's important to note that they're not only stock pickers but rather business pickers. As opposed to trying to outsmart the market through frequent buying and selling, these investors purchase publicly listed equities based on their beliefs in the company's long-term potential. Picture yourself entering a world where companies have more than just tickers and numbers. They have personalities, histories, and opportunities all their own. In this scenario, the stock market represents the corporate world and provides opportunities for investors to back companies that will last. Warren Buffett is like a bold explorer in his approach to investing. He boldly goes where others are afraid to go. He's a contrarian investor who looks for bargains while everyone else is fleeing the market in panic. Buffett increased Berkshire Hathaway position in Apple, reiterating his optimism in the company's long-term potential despite the turmoil of the previous year. Buffett often includes signals about upcoming stock buying prices in his yearly letter. His resolve to have a boatload of cash indicates his eagerness to profit from market losses, while others are apprehensive. This knowledge is crucial for investors to handle market swings successfully. Having cash on hand in your investing portfolio gives you the opportunity to buy low and sell high during market downturns. When market conditions change, this strategy will put you in a better position to profit. In times of market uncertainty, Buffett's advice shines like a beacon. It's smart to keep putting money into your 401k every month, even if the market takes a dip. Investing is all about riding the ups and downs of the market in pursuit of the golden rule: buy low, sell high. The real trick is understanding that the optimum time to make money are when prices are falling and doubt is clouding people's judgment. Investors avidly scrutinize Warren Buffett's yearly letter for insights into his secret sauce in the pursuit of replicating his renowned financial success. This year, though, they hit pay dirt when Buffett gives away his most precious commodity, time, in an entire chapter. In essence, he teaches an important lesson about the value of patience, which is especially relevant in light of the recent increases in market volatility and investor anxiety. The value of investments can grow exponentially over time thanks to the magical effects of compounding, which Buffett highlights. He spins a yarn on about how Berkshire's early investments in Coca-Cola and American Express paid off handsomely with a combined $25 billion and $22 billion in market value over the past 3 decades. Berkshire has received almost $1 billion in dividends as a result of these investments, a significant but often overlooked contributor to portfolio results. It's interesting to note that dividends have played a major influence on market performance in the past. The power of compounding and reinvesting dividends account for 84% of the total return of the S&P 500 index during the previous 50 years. Average dividend income contributed 40% to the total return of the S&P 500 index from 1930 to 2021. Buffett's extraordinary success story emphasizes the value of keeping long-term horizon and exercising patience when investing. The vast majority of his estimated $106 billion fortune was amassed after he turned 50. He represents the idea that making money in the stock market is a marathon, not a quick dash, and that sustained effort over time is what really matters. The weeds wither away in significance as the flowers bloom. Buffett advises investors poetically. Finding a handful of profitable assets and allowing them to compound over time is the key. While getting a head start is always helpful, the actual power of compounding only becomes apparent when you reach your 90s. So that's a wrap on the video. I hope you liked it. If you did, please give it a thumbs up and don't forget to subscribe. Thanks for watching. See you next time.